Hi, Latoya and Ed. This is Patty. I just wanted to give you a little overview that both of you can watch. I'm talking about an FHA loan here. Obviously, the Milan is $484, and that includes $20,000 in upgrades that you get to choose. And the thing like the finished basement's already included in things. So, I'm thinking with a lot premium, I'm ballparking that with lot premium and some of the upgrades and flooring that you want, you're probably going to be at a final number of about 510, maybe less, but let's go with 510. On an FHA loan, that means you would need to have $17,850 down at 3.5%. That's 3.5% of the loan amount. You would have a funding fee that would be paid up front, and it would be actually, it's a VA funding fee that they will add into the home loan. So it'll be $348.61 a month. This will go away once the value of the home increases enough so that you're at 80% loan to value. So in about 4 years, you'll drop that payment off, which will be a nice surprise for you. But in the meantime, your taxes will get added in here, your homeowner's insurance, your fee for being an owner at Potomac Shores, and that does include your internet and your phone in that fee there. So that'll save you some money on your regular bills. So under this scenario, your total payment comes up to $31.82. Yes, $31.82 is the base mortgage payment. That's the worst case scenario. Well, based on Latoya's income, if we were looking at it, Latoya, with the 2 car payments and your income right now, we could push it to 50% ratios if you have good credit, and that means if you have credit of 680 or better, and then that would allow you to qualify for this home. It would be marginal, but you could do it with both cars. The lender might need you to refinance one of the cars. We'd have to talk about that, but you could definitely do this on your income. So that's the good news. Now I want to show you the benefit of ownership. Here's the bottom line. If the loan is $492, your principal interest is $2209. Your mortgage and taxes are $416. And then you go on down through here. And what this is telling us is that based on your after-tax payment of that $3,100, after you do your taxes at the end of the year, your actual payment is going to feel like $26.79, which is right in your sweet spot where you wanted it to be. And here's the plain English of that. It says, if your home is valued at $510, for example, and you take out a loan for $492, the total monthly payment may come out to $3,075, and then add on your HOA. After considering all the factors described above, due to the savings you will receive from a tax benefit, however, your average payment will be $26.79 during the first 10 years. If you decide to live in the home longer than that period, it will be $26.53. So, needless to say, the tax benefit is really beneficial to you, and you will get that back each February. You'll get that tax return. So what they're saying there is that $3,100 versus that $26, there's almost $500 a month that will be returned to you in tax. So that's about $6,000 additional tax return every February. So that's a real tax benefit for you. So I just want to make sure that you see that. I'm actually going to include these calculators in my email so that you can then see if this is something that will help you to move through the process. If you have any questions, feel free to give me a call. I'm going to go ahead and forward this link to you so that you can hear my voice and see what the tools are here. And just know that these mortgage calculators, you can play around with them a little bit, and it says save money. What if I made an extra payment on my mortgage? Let's say my mortgage was $492 was the actual mortgage. $492, and the interest rate was 3.5%. You can see here it's 30 years. And what if I put a $200 extra, or no, let's say $100 extra on each payment? What would happen? This is always fun to see. It's saying here that if you did an extra payment, you pay an extra $100 each month, you will pay $770,000 toward your home. The average savings, you'll actually pay your loan off in 2 years and 1 month sooner than you would have if you paid the regular payment. So you can see if you add $200 or $300, you can really start to cut time off your loan also, and get that equity faster so that you can get rid of that mortgage insurance premium. So there's all kinds of ways to make this work for you. So just wanted to give you an idea of what's possible. Be happy to coach you through, but I do think we can qualify tomorrow for you too if you want to move forward.